Well, good morning. Welcome to the Data Explorers Securities Lending Update for Tuesday, the 18th of November. I'm Ed Oliver. So starting today with regulatory and short selling news. Some interesting reviews coming out of India over the last couple of days. The Indian Business Standard reporting that short selling by foreign investors isn't the reason for the precipitous fall in the stock market in India. According to numbers put out by the government over the weekend, of a total of 100 billion shares available for loan, only 192 million were actually lent by them or by foreign investors through to the period of October the 8th. That's just 0.2%, proving in the view of the Business Standard that short selling was not the reason for stocks and indices hitting new lows in recent weeks in India. Now, interestingly, today they report concerns from participants in the domestic equity markets who are still wary of overseas stock lending and borrowing operations, and suggest that nearly 50% of the total selling by foreign institutional investors over this period has been actual short selling, or certainly lent securities for short selling purposes. So they're concluding that actually they don't think that short selling has been quite so innocent as suggested by the government. What's obvious from this is that there is a need for more transparency in India so that whichever side is correct, they're getting the right information to draw the correct conclusions. Just staying on regulatory for a minute or two, Australia tomorrow lift their restrictions on short selling of non-financial securities, providing the seller has borrowed stock. Naked short selling will continue to be banned in Australia. So we'll be keeping an eye on progress in Australia over the next few days here on the Daily Update. In the Financial Times this morning, there was a report on the slowdown survivors, those companies that have benefited from the credit crunch. And we can take a look at some of those now and what that's meant for securities lending activity over the last 12 months. Kicking off with pawnbrokers, and Harvey and Thompson are one of the names that have benefited from the demand for smaller loans by consumers. They're generally regarded as the lender of last resort and have reported strong increases in both sales and profits recently. As we can see from this chart, Harvey and Thompson had about 10% of their shares outstanding on loan earlier this year. That's dropped to around 5% most recently. Other companies that have benefited from the credit crunch are those that have profited from people staying at home more often. Names like BSkyB and Virgin Media have reported rising revenue and profits as families spend their shrunken entertainment budget staying at home and buying a month's worth of subscription television rather than going to the movies. As we can see from this chart, British Sky Broadcasting, 4.5% shares outstanding on loan earlier this year, and that's dropping down to sort of the 3.5% range more recently. Other names that have benefited are Pace PLC. Pace make the boxes that sit on top of your TV and get the data that comes from the subscription channels. They've lifted half-year revenue to 22%. As you can see from this chart, really over the last 6 months, shares outstanding on loan pretty insipid, really, 0.3%, pretty consistent through the whole of the 6 months. And finally, more evidence of a shift to more affordable entertainment options is reported from Durex. They're the condom maker that's part of SSL International. Durex sales growth has been running close to 10% lately. And you can see from here again, fairly limited interest on the loan side. Shares outstanding on loan running at about 1.5% right now. So there are some winners from the credit crunch. We've named just 4 there, and we'll be continuing to focus on those stories on future daily market updates here at dataexplorers.com. For more details on broader pictures of the industry and more commentary on what's going on in securities lending, check out the website of Spittlefields Advisors. That is www.spittlefieldsadvisors.com. That's all for today. Thanks very much.